Welcome all to the FSC Mid-Year Financial Cycle Summit. 3 days of jam-packed market outlook, all with a cycle focus. That'll be today, June 25, tomorrow 26, and the following day 27, with 2-hour sessions each time. We're just going to wait for a moment or two as all join. A big welcome to everyone. If you could type in the chat where in the world you are from, just as we warm up into our intro. A big shout out for the highest record signups. Thank you for attending today. Thousands of registrations. FSC Mid-Year Financial Cycle Summit. As just mentioned, this is live, 2 hours immersion, 6 speakers in total. Now, as part of the FSC Social, we like to make sure that we're interactive and engaged just ahead of the debut speaker, which I'll introduce in a moment. So please share your response into the YouTube chat box, which country in the world you are based in. And then in addition to that, if possible, any market cycle views or key insights that we can share here as we kick off. I'm your host, FSC Development Director, Ron William. Always a pleasure to host these events and to contribute on the monthly vlog that we share. Now, for today's program, kicking off very soon, we have Peter Eliades that'll be talking about what are the very long cycles suggesting about the current market, and does AI change the picture? Peter Eliades began his career as a stockbroker, appearing as market analyst on FNN. From 1975 to 2011, his stock market cycles newsletter predicted amazingly accurate stock market highs and lows. Eliades has regularly appeared on Business World, CNBC, Wall Street Week, and Nightly Business Report, and has been featured in Barron's, The Wall Street Journal, Forbes, and Futures Magazine. Following on, we'll hear from Jake Bernstein, and I'll talk some more about the other speakers that will follow on day 2. Dr. Richard Smith, our FSC chairman, Lars von Thienen, board member, Bill Sarubi, and Andrew Pangeli also on the team. And with that, I'd like to introduce our lead keynote speaker, Peter Eliades. Welcome, Peter.
Thanks a lot, Ron.
Over to you.
Should I fire away?
Please do.
Okay. This is really a lot of fun for me, and this is a great time, I believe, to be doing this presentation. People that are close to cycles tend to have good timing, at least better timing than those that don't. So let me give you a couple of reasons why. Now, the first thing, the main subject that I said I'd be talking about would be long-term cycles. We'll get into that in a minute. But because of where we are in the overall market right now, I wanted to show you this chart. Now, it looks mumbo-jumbo to most of you, and this is a program that was written for me by Stefan Scheuermann, a German gentleman who now lives in Dubai. I've looked for a programmer for, gosh, 30 years to do my cycle projections. And when I say mine, it's just a slight variation on the original Hearst technique of doing price projections. I expanded it out and worked with daily trading day charts rather than calendar day charts, which is the way Hearst did it originally, including Saturdays, Sundays, and holidays as spaces on a chart. I brought that in and made them a daily chart, trading day chart, leaving the spaces out. That's a very quick explanation of some of the variations that I put in. And the offsets that I do are, a lot of them on the daily charts are fractional, and that's what stopped a lot of programmers. They couldn't do fractional offsets. Well, I found someone that could, and Stefan did a fabulous job with the software. The basic idea is, when this is a chart of the S&P, you can see a bar chart of the S&P 500. When it moves below a particular offset that you have on there, it gives a downside projection with this red box. When it moves above, it gives an upside projection. Now, this is a huge box here, and you might think, well, what good does that do me if you tell me we're going to stop somewhere between the lower end and the upper end of the box? The reason for that is that if you see the distance apart that the offsets got crossed at, the initial crossing was down here and the final one was way up here. And that's the thing that made this box so big. But watch this. This is fascinating. I can extend right on this projection box and look at this. This is the high that we saw 3 trading days ago. It was at 55.05.53. The upper end of the projection box, 54.89.11. So this reading that we saw on Wednesday of last week, I think it was, the high was 55.05.53, and here was the projection. So it was within 0.4%, this high of the very upper end of the projection. That leads us to believe that at this point, this could well end up being an important market top. Now, what happens with cycle projections is you can get what I call loop projections. And those occur when you have a decline like this, and then you have a short-term crossing of the offset again. So in other words, this decline becomes an offset further out in time. And when you cross above that, you get a higher projection. Well, that could occur here, okay? Won't necessarily occur, but it could occur here. And if it does, yes, we can get higher projections. But those are short-term projections. We should be at the tippity top of this projection box for the S&P 500, okay? I want to show this to you. Now, let me show it to you in a better fashion where it doesn't look as ugly as this. If I go to show web chart, and then come down here and click on my web chart and make it a full screen, this is a better representation of what we're looking at. What you're looking for is a crossing. I call this the continuum because what this gray area, this continuum is simply moving the shorter offset, let's see, that's represented by right here, across to the right to the longer offset, okay, on the chart. And that is the continuum. So anytime you cross above or below the continuum, that means you're crossing above and below any place in between the two offsets. I know I'm going through this rather quickly. Phone ring. Okay. We have a power outage here. Thank goodness I have a generator. That's the only reason I'm able to do this presentation today. Our power has been out for 15 or 16 hours now. That was PG&E telling me about it. Okay, so here's what happens. When you cross into the offset, you get preliminary projections to the downside. This is a downside crossing, okay? You need to get below both the upper and lower end of the offset in order to get a confirmed projection. So we never got a confirmed projection here. We just got preliminary projections. Finally, up here, we got a confirmed projection when we got below the lower end of the offset. This was the confirmed projection right here. And as you can see, we came well into that projection window, okay? I'll go back to the chart and show you these numbers if you want, but I just want to make the concept clear to you now. So now from this low that was established in October of 23, we got into the continuum to the upside right here. It actually happened way down here. And that's the reason why this box is so large. We entered the continuum at a really low area and didn't get above the upper side of it till a very high area. And that's what created the upper end of the projection window, okay? It's a lot clearer to see it with this continuum that is on the chart itself. Let me go back to the chart itself quickly now, though. And so you can see now, this was the downside projection. This called for 38.15.83 to 42.32.50, okay? Now, this, as I said, is the longest offset we put on the daily chart, On the weekly chart, there's one longer offset. This is the equivalent of a 100-week offset, 100 to 110 week. And the longest one of all is 200 weeks. That's on the weekly offsets. So what the other fabulous part about this software that Stefan wrote is you can go to statistics. Now, there aren't going to be too many statistics for the 2-year offset. They might not even look good. I'm not sure I should show them to you because it's, but let's do it. Let me take the risk here and show you right here. See, this is a fabulous part of the program because look at this. Okay, over the whole period of this, there was one upside crossing and one downside crossing. And so it gives you the percentage, how many times, how many projections were given and how many of them were met. Now, this covers a period of almost 6 years here. So the reason we've only had one crossing to the downside and one to the upside is because it's the longest offset we use. You very seldom see them get crossed. But when you use shorter offsets, this software tells you, hey, how successful is this offset in giving projections? And so it'll just take the confirmed projections that were given. When it says confirmed, that means you have to cross above the full continuum to the upside or the full continuum to the downside. That makes it a confirmed projection. So we're 1 for 1 in the last 6 years of this chart. This is the downside. Here's the upside. I just showed you how we just now reached the very upper end of that upside projection. And I wanted to show you that because that makes it exciting times. There are other things that make it exciting times too. You know what? Let me quickly show you a few things here before I get into the really long-term chart, which is the basis of this whole presentation. There's another chart that I'd like to show you, and it's this one right here. Look at this trend line. This is a fabulous trend line that we just hit last week. It's a weekly chart of the S&P 500. This is the high in 2000, March of 2000. This is the high on January 4th, weekly chart. So it'll be the week that included January 4th. And this is last week. We came up. I had an exact number for the trend line. I think we got above that trend line by maybe 0.2% so far. So we haven't made any decisive turn from that point, but I wanted to show you this trend line because so many things appear to be coming together. Just consider this. This trend line was being hit at exactly the same moment as that very long-term upside projection on the daily chart was being reached. And that one exceeded by 0.2%. I think the trend line was exceeded by maybe 0.3%. So all within 1%, okay? All right, now let's go to the long-term chart. And this chart, we give thanks to the foundation because they provided the data for this chart. This is a monthly chart of U.S. securities prices, 1789. I think the way it's currently set up, it's charted into November of 2023, although I may have added a few more months in here since then. I don't remember on this particular chart whether I did. But here are the things I want to show you. There are two concepts here. One of them is very simple. Look at this chart going back to 1789, folks. So what are we talking, 230 years? This is 1789 back here. Now, when you work with Excel, Excel doesn't recognize dates before the year 1900. So I just numbered them and I couldn't put dates on them. But what I did was at the top of the chart, at certain important time zones, I put the dates in so you can get an idea where things occurred. So this top occurred in 1835. And I think just using your eyeballs, you can see that the two largest declines in the United States security price history began in 1835 and in 1929. Okay, this was a decline, according to the data from this chart, of about 85, 87%. This, we know, in the Dow Jones Industrial Average from 29 to 32 was over 90%. I think in the S&P it was about, again, 85 or 86%. So these were the two largest declines in U.S. securities history, okay? So let's very simply just take the distance from here to here, 1835 to 1929, 94 years. That projects to 2023, last year, okay? And now I want you to remember that there are some indexes, particularly secondary stock indexes like the Russell 2000, that reached their top in late 22 going into 23. So we've seen a whole bunch, a whole series of tops. Dow Jones Transportation Average topped out in November of 21. So we have these various indexes and averages topping out. Tops tend to be broadly based, okay? If you look back at the history of the Dow Jones Industrial Average versus the average share of stock, the average share of stock topped in 1968 and went down to a bear market bottom in October, December of 74, okay? But it never went to the new highs that the Dow reached in 1968 or 1966. Actually, 68 was the top. And by 1973, when the Dow Jones Industrials and the S&P in January of 73 reached new all-time highs, the secondary stock indexes were nowhere near. So I'm bringing that up just to show you how in these long-term patterns, tops come at different times. Tops tend to be, what's the correct word? Not dispersive, but they tend to last over longer periods of time. Bottoms tend to be more direct, and they tend to occur almost simultaneously. In 1974, it was October and December of 74, a double bottom. Some indexes went lower in December, some went in October. Most of the stocks bottomed in October of 74, okay? That was back here. Here's this little point right here, December of 74. Okay, so, but very simply, let's be clear about this. You can't really call this a cycle yet because there's only one iteration of it, 1835 to 1929. But isn't it fascinating that now, 94 years beyond this 1929 high, we saw the market making new all-time highs again. So it would be difficult if there is going to be consistent spacing between tops to call what's going to occur in a year anything but an important, potentially important market top. Okay, so that's one long-term pattern I want you to be aware of. But there's another one. Take a look at these two lows. 1842, 1932, and can any genius tell me when the next point would be due? Well, it's written right up here. Bottom to top. Now, when I first started studying cycles, and believe me, it was a long, long time ago. We're going back to the late 1960s, early 1970s. I always, in those days, we didn't have computers, folks. They can click here and click there and say, okay, that's so many weeks. Let's go out that same distance in the future. You sat there with the Mansfield charts and you counted them out 1 week at a time. It was a very tedious procedure. But a lot of times the results were very satisfying. One of the greatest calls I made in my career was on Los Angeles television, Channel 22, the nation's first financial station. I was on there from mostly through most of 1974, and I had discovered a 212-week cycle in the stock market. And it was due the week of December 9th to 13th of 1974. And I kept repeating those dates especially through the latter part of 1974. We bottomed in October, had a big rally, but then we started coming back again. And I kept saying December 9th to 13th, 1974, major bottom. And guess what? On exactly December 9th, 1974, the Dow Jones Industrial Average bottomed out at 570.01, and the rest is history. It was a beautiful cycle. If you look back at that cycle now, it didn't really continue too well into the future, but it really did a great job in pinpointing that bottom in 1974. So now we have these two bottoms, and I started to say that I was distrustful of people that talked about bottom to top. George Lindsay, who was a past cycle master, was the one that came up with that concept. He said that most, if not all, of the stock market tops that he dealt with had some kind of bottom to top count behind them, or the substructure. Okay. So if we look at this now, and if we say 1842, 1932, you're talking about 90 years. You go 90 years forward from 1932, that takes you to 2022. Well, mind you, these were two bottoms that occurred, and you might logically ask the question, well, if you think these two tops are going to lead to a top, why don't you think these two bottoms are going to lead to a bottom? And I would say to you very simply, the answer is really simple. If we were having some kind of significant decline into 1922, I would say, yeah, you can look at this and say, yeah, we're due for a really big bottom here. But when you see the market move directly up into 2022 and reach an all-time high, in fact, the Dow and the S&P, I know the S&P was January 4th of 2022, the initial all-time high. So when that was happening, you don't look at that chart and say, whoa, are we looking at another bottom here? Of course not. You're not looking at a bottom when the market is reaching all-time highs. So you look at the Lindsay concept and say 1842, 1932, 2022. So now on this very long-term chart, we have two cyclic periods, potential cyclic periods, I should say, because again, you can't call this a cycle either. There's only one iteration of it. But when we see them fit in so well, this one calling for 2023, this one on a bottom to top concept calling for 2022, you have to think, hey, this is a really important time zone up here, 2022, 23, and obviously we're into 2024 right now. Okay. All right, I'm checking my watch here to see how much time I have, but this is 25 minutes. Okay. So this tells me that there's a very good chance that we could be seeing the formation of what could be a very important, maybe even historic market top in this current time zone, 22, 23, 24, okay? Based on these four dates right here and the formation that we see, the two largest declines in market history and the two most important bottoms that resulted from those declines. That's what sets up this area as being a potentially very important market top. Now, what else do we look at to determine whether indeed they may be a market top? Well, valuation comes into consideration. Now, you have to be careful with valuation. You look at PE ratios and typical things, dividend yields. Some of the past market masters, I mentioned George Lindsay. The other one that was to me in my era, and he was Edson Gould. Fabulous market analyst, made some great market calls. He kept raving about how a 3% dividend yield in the major averages was a very big danger sign. Well, Edson is probably turning around in his grave 10 or 15 times because we started to see 3% dividend yields at the beginning of this century. Okay, this beginning, and call it the beginning of this millennium too. we started to see 3% dividend yields, which would indicate that you're probably near an important market top. Well, you can look at 3% dividend yields, and we've been at those levels now for a good part of the 24 years of this century already. Excuse me. So that's one way of looking at value. The valuation person that I like the most because of his long-term work, and he's viewed as a perma bear. A lot of people view me as a perma bear. That's because he has shown the market to be overvalued for quite some time now. But let me show you one or two of his charts and show you what I'm talking about. The first chart I'm going to show you is a valuation chart. Okay, I'm not going to go through that. I'm not going to take the time to go through the explanation of how this chart is constructed. But what I can say is you can go to his website, just Google Hussman, Hussman, and take a look at this chart. As a matter of fact, this is not even the chart I want to show you. I have one that has a line on it that I want to show you. Let me see if I have it. Yeah, that's not going to pop up. This is good enough. This was where we are valuation-wise on June 18th of 24. That's a week ago, folks. We were right here. If you draw a line to the left from here, covering 100 years almost, back to 1928 of history, it'll be above virtually all these lines that you see. It will be above 1929. The only time zone it won't be above, where there's like maybe 3, 4, 5 weeks in here. This was late 21, early 22, 2021, 2022. So this chart shows you on a somewhat objective basis. I mean, you can call the setting up of this valuation chart subjective, depending on how you want to define it and how it's constructed. But you can see that it has a very long history, an almost 100-year history. And as you and I are talking a week after June 18th of 24, this is what we see. We are now at the most overvalued market, minus a couple of weeks in this zone here, in the history of markets, of U.S. securities markets, going back 100 years. So that would qualify, okay? That would qualify and fit in very, very nicely with the charts that I just showed you, the long-term charts and the projection meeting that we saw on the S&P 500. Okay, there's one other Hussman chart I want to show you. I enjoy his work immensely, and I would recommend that you look at it. Again, he's carried the moniker of being a perma bear because we have been overvalued for a long time now. And the only time I think valuation really has to be paid attention to is when you get to historic extremes. You see, all the way through the last 5, 10, 15, 20 years, when even back to 2009, when you can argue we were fairly valued, we certainly weren't undervalued. 1982 was undervalued. We were fairly valued, okay? So you can argue that at that time was the last time, 1982, that we were undervalued. We have been overvalued for almost this whole century. But now we are at an extreme of overvaluation, and that's when you have to pay attention. I wanted to show you this. This is something from Hussman. It goes back 30 years. And what he looked at, these are 1, 2, 3 parameters. The S&P 500 has to be at a 5-year high. The New York Stock Exchange stocks at new 52-week lows are greater than the number of 52-week highs, okay? And that's happened over the past week or so. And advisory bearishness, according to Investors Intelligence, shows less than 30% bears. These are the 3 parameters that he looked at. And these are the only 3 times, or actually 4 times now, in market history of the past 32 years that those have occurred. Little premature here in 2000, but a really good call. This is the late 2018 high that saw a very significant decline. This was the prior all-time high in January of 2022, and this is now, okay? This is over the past week right here. So another thing that shows the kind of extreme nature that we're at in the market. Okay, I only have about 5 or 10 minutes left. I'm going to leave time for questions. So here's what I want to do. Everyone's talking about AI. Oh, what a fabulous concept. Artificial intelligence. It's going to change our lives completely. It's going to completely change market valuations. We don't have to worry ever again about, as the Yale professor Irving Fisher said in 1929, we have now reached a permanent high in stock prices, a permanent plateau, I think is the way he said it, implying that, yeah, we'll have 10, 15, maybe 20% pullbacks, but you're not going to ever see the market go below these current levels by a significant amount. And he said that just before the markets went down 90%, okay? So we have people talking about that now, artificial intelligence. Let me show you some data here. And it knocked my socks off. I hope it knocked yours off too. Let's look at them. Okay, whole bunch of things in here, and they're all important. These are the current, when I say current, within a few weeks, capitalizations of the 3 largest capitalized stocks in the United States. Apple's capitalization, 3.4 trillion. Microsoft capitalization, 3.3 trillion. Nvidia capitalization, $3.5 trillion, okay? These are the GDPs of 3 very large economies in the world. This is the German GDP, this is the UK GDP, and this is France's GDP. I just put the populations of those countries underneath so you can see that they aren't 5 million population countries, okay? 3 of the largest economies in the world. Do you see something amiss here? Each of these stocks, you can argue, is being valued, is being capitalized at the GDP of these 3 countries individually, give or take a little bit, okay? So think about it. Use your brain and think about this. The GDP is talking about every single good and service that is producing income in those countries, and that includes rent and things like that. It's not just cigarettes and groceries, okay? And it's the services involved in that country. Everything that leads to income in those countries is included in the GDP. So let's go down a little bit further. There's a whole bunch of interesting factoids here. Nvidia joined the $1 trillion club in May of 2023. That's a year ago. Since then, Nvidia has added $2 trillion of capitalization in 1 year. The total capitalization of the German stock market in December of 23 was $2.18 trillion. So here's one stock that serves the gaming industry, okay? I know they do other things. I know there's excitement about AI, but they basically serve the gaming industry and they make great chips and great processors. But you're telling me that in the last year, their valuation has exceeded the complete valuation of the German stock market. Think about that. It's so crazy. Again, you can't time the market with valuation, but you can sure see where people making fools of themselves, okay? All right, a little further down, and then I'm through. Ready for questions. The total market capitalization of the US stock market at the bottom of the market in March of 2009 was approximately $9 trillion. That's 15 years ago. The total capitalization of our stocks in this country was approximately 9 trillion. Add these 3 up right here. Apple, Microsoft, Nvidia. That's over $9 trillion. So you're telling me that these three stocks, this guy sells computers and watches and maybe a few other items, telephones, Microsoft, software, operating systems, Nvidia, we just talked about. These three stocks, the valuation of them today is worth more than the complete United States stock market in March of 2009. Think about that. Think about, you say, well, what was in the capitalization? You go, well, real estate investment trust, huge operations that included maybe most of the commercial real estate of the country, all the goods and services of the country. It's incredible. Here you go. Apple, Microsoft, Nvidia, worth more than our complete stock market in 2009. I want you to conceptualize how much a trillion is now. And this is fun. How long ago is 1,000 seconds? 1,000 seconds is about 17 minutes ago. How long ago is 1 million seconds? About 12 days. Go back 12 days, you've gone through 1 million seconds. How long ago does 1 billion seconds? Well, now you're talking real time. 1 billion seconds is 32 years ago, back to around 1992, okay? How long ago is 1 trillion seconds? 31,709 years ago, around 29,684 BC. That's how much a trillion is, folks. And with that, Ron, I think I'm through and ready for questions.
Hey, Peter, fantastic presentation as always. We have the audience on edge with plenty of questions, and I'll start up the top. Irrational exuberance markets can stay far stronger than we can stay sane. My reframe of the age-old,
which is absolutely true, absolutely true. But this, I think we've gone beyond even irrational exuberance here.
Well, exactly. I mean, there was an interesting exchange between Robert Prechter and myself early on in this year, and it was on the extent of just how extreme optimism this market cycle is compared to past ones. So perhaps if I kind of build from that point, in all your experience, Peter, how crazy is this market elevation?
Okay, can I show another chart? Am I still on the
Please.
sharing thing? Okay, let me give you an idea of, I have a chart that I think is a perfect indicator of that. And it's right, let me do this. My stop sharing thing is, hold on a sec. I'm gonna make my screen smaller. Here, and now I can do this, and now I can do this. Okay, this chart that you're going to see here is a ratio of the SOX, the semiconductor index, to the Dow Jones Industrial Average. And fortunately, it doesn't go back 3 or 4 years. I'll show you how far back it goes. It goes back to the craze in the markets in 2000. Let me show that to you. Right back here. Look what happened in 2000. So I want you to appreciate a couple of things. First of all, this is the semiconductor index, Philadelphia, symbol SOX. This is the typical valuation ratio. Semiconductors to the Dow Industrials, which is obviously potentially a conservative thing. The ratio ran anywhere. You can see the scale over here on the right, between maybe 6% on the high side, around 2 or 3% on the low side, all the way from 94 into 99. And this is what happened in that dot-com craze in 2000. The ratio got up to 13.4%. And then from that point, the SOX was down 80% into October of 02, and watch it again. I'm going to slowly scroll to the right. this gives you an idea of tech valuation versus the rest of the market. 05, 06, 7, 8, 9, 10, 11, 12, 13, 2014, 15, 16, 17. You can see it's remaining within those parameters. Once again, 2020, 21, even at the 21 top in the NDX, which was right here, actually right here in November of 21, 22, it didn't get up to the 2000 level, but look what's happened just in the last few months. This is March of this year. It finally reached that level that we saw in 2000. Excuse me, started coming down from there, had a big decline. The SOX was down 18, 19% here, almost had a bear market from March, April into May. But look what's happened in the last month, right up here. Again, it's like irrational exuberance. This is irrational exuberance right here, okay? That's the ratio of 13 to 14%. This is craziness. And this is where we were as of last week, right up here. I think it gives a pretty good picture going back of 30 years or so of the really exuberant times in the market and where we are in relation to all of them right now.
And to follow up on that point, Peter, we have a question here from our team in terms of tools. I mean, more of an education insight question, tools that you may use to tell whether an extension in a cycle has staying power or will revert, whether it be this cycle that we're in or in general.
Yeah, that's very difficult to say. You know, I used to spend most of my time, when I say used to, I'm going back to the late 60s, early 70s when I started studying cycles. And over the next 10, 20, 30 years, most of my work was with time cycles. I spent innumerable hours, days, and weeks looking at those Mansfield charts and counting the cycles. As I went further and further into my experience, I started, because I got into the Hearst price projection thing, I got much more involved with the price projections that are involved with market movements than I did with the time cycles. Don't get me wrong, I still look at and respect time cycles, whether it be bottoms to bottoms, tops to tops, bottom to bottom to top, or even short-term trading cycles. I still look at them, but it's impossible to predict when they're going to extend. And that's one of the reasons why I turned more and more towards the projections, because if projections extend out by giving what I call those loop projections, all the information is there in front of you. And by the way, let me give myself a quick plug. If folks want to take advantage of either the software that does those projections, if they have TradeStation, or if they want to listen to my videos, they're welcome to go to the website and get a free 14-day trial to either the software itself individually, the video commentary, daily video commentary, 14-day free trial, or a bundle of both of them. Free trial for 14 days. stockmarketcycles.com/register is where you go.
For all those who are keen to actually follow Peter's work and also apply the cycle analysis that he's just shared, feel free to do so and play back for those details. We can also follow up as well. And Peter, just to build on the setup here and now, what's your view? I mean, over the next few weeks, months, I mean, you mentioned NVIDIA, that's already nosediving as we speak. I mean, is that got you concerned? Is it too early? Or do you think this could be a big move ahead?
How much time do we have? Because
we still have time.
I showed subscribers 2 weeks ago a chart of NVIDIA and a chart of Apple. Oh, I know what I wanted to show. Let me see if I have time to show this.
Because I'm sure everyone will be interested to hear, Peter.
I wanted to show Apple Computer and a projection that was
I mean, the latest stats was that NVIDIA was more than half of the market cap now of the S&P 500 in terms of year-to-date gains.
It's just ridiculous.
So,
I mean,
so it's truly in everyone's mind.
I don't care how excited you are with artificial intelligence. What exactly income? That's what we're talking about, basically. What income additional income are they going to produce for companies, for restaurants, for barbershops, for real estate investment trusts, you know? Okay, so look at this projection on Apple. This is a weekly chart now. So when I right click here, it shows all the defaults for weekly charts. These are the offsets, which are the half spans of the nominal cycles. This is the offset for a nominal 5-week cycle, which is 2.5. Nominal 10-week is 5. 10-week offset, 20-week. So this 20-week offset on Apple Computer gave this projection. Let me zoom in on this so people can look at it more closely. Here was the projection. Here you can see it more easily here in terms of the crossing. This is a 20-week offset. And for those that are new and don't understand the offsets, it's simply taking the median price, the mid price of the bar every week, and moving that median price forward 20 weeks. When you cross above it, it gives a nominal 40-week projection. And this was given, okay, on this week right here. Now, it looks like it extended a little bit. You also have the ability to do logarithmic projections, which means you don't just look at the price difference between the low and the crossing. You look at the percentage change from the low to the crossing and add that percentage change to this halfway mark. I'll show you what the log projection was for Apple. There's the logarithmic projection for Apple right there. So when you reach this area in here, and again, this is all of you that are interested in this kind of thing, you've got free 14-day trial to use this software on TradeStation. This gave this projection. Now you say, well, what about the other offsets? Well, if I'll go try and go through them quickly with you, you can see that here was the first upside projection right here. That was obviously met. Let's go through them very quickly. Here's the 5-week offset. That was a little bit higher. That was obviously met. Here's the 10-week offset. That was up here, and that was obviously met. And here's the 20-week offset, 40-week projection right here. Now you say, well, keep going out. Let me see if there's higher ones. Okay, I'll do that for you. Here's 39 to 40. That was actually a little bit lower. How about the second to long? Here's the 2-year offset, 100-year. 100-year, 2-year offset, nominal 4-year projection. And let me show this more completely. You can see we never got below that to get an upside projection. So the only upside projection that was outstanding on Apple Computer was met right up here. At the same time, this is interesting. See this trend line? This is the high in August of 22. This is the high in July of 23. Now it looks like we just fell short here. Well, that's because this is a log chart. Let's go to quickly, if we can, time frame, customize. When the prices are that close together, you should be using not a semi-log, but a linear chart, and watch what happens with that trend line on a linear chart. Bingo. Perfect. Look at this. Top, top, top. These are almost exactly the same distance apart. If you look at them on a daily chart, they are exactly the same distance apart. So you have 3 things working for you. You have this beautiful trend line, tops line. You have equidistance between them, and you've got the meeting of a projection right here. So do I want you to go out and mortgage your wife, husband, children, home, and family and short Apple Computer? No, I don't. I'm not making any recommendations. I'm just presenting to you the technical facts.
And just as a grand finale question, Peter, some macro thinkers here at FSC are thinking in a downside scenario, inflation, deflation, and let's say it's the latter, precious metals and silver as a case in point, or even gold. Do you have any top of mind views on both or either?
I do. Recently, over the past several weeks anyway, I told people that I know that a lot of people got very bullish on gold, and that typically happens when you have a big advance in something. We were reaching upside projections for almost all of my gold projections over the past couple of weeks. So short term, I don't have anything higher. Now, as I said, if we get a decline of any significance and start coming up again, then we can get higher projections. But I'm not one of those that's looking for, if we have a huge market decline, which we could very well have, I'm not one of those that's saying at the same time, gold will be going significantly higher. Because if it is a deflationary scenario, it's deflationary for everything, gold included.
Relative performance, ultimately, everything gets hit.
Yeah.
Thank you very much, Peter, for a fascinating presentation and for your engagement on the Q&A. We really appreciate it. Thank you.
Oh, I enjoyed it. Thank you.
And now to follow our next speaker, Jake Bernstein, FSC Development Director, who will be talking about fastening your seatbelts. The next 6 months will be epic. The cycles are talking. And the open question, are you listening? So just as a brief and welcome intro, Jake Bernstein, publisher of Jake Bernstein's weekly futures trading letter since 1972. Bernstein is regularly quoted in financial press and on financial websites, including Wall Street, Week, CNBC, JagFN.tv, and WebTV.com. Traders and money managers, both new and experienced, subscribe to his market advisory services. He has been trading futures and stocks since 1968. Welcome, Jake.
Well, thank you, Ron. Thanks for having me here. Can you hear me okay?
Yes, I am. And my seat is getting fastened as we speak.
Well, I see you're putting all the old guys first.
Well,
thank you.
The wise insights to lead.
Thank you. So let me begin by saying this. One of the first things I learned about trading was this. Mine is not the reason why. Mine is but to sell and buy. So I don't think about the fundamentals. I don't think about overbought. I don't think about oversold. I just think about the patterns and the cycles and the timing. That's all it is for me. Now, pardon the voice. It's a little bit of an allergy season here in California. So whatever time it is, whatever day it is, wherever you are, if it's today, tonight, or already tomorrow, thanks for coming to my talk. I appreciate the opportunity. It's an honor. And I want to commend all the great people at the Foundation for the Study of Cycles for bringing education about cycles and patterns to the general public. I know that most people in this business, especially customers, are very poor at discipline. They don't like to listen to the rules. They don't like to follow the rules. And in fact, most of the time, they don't know the rules. What I'm going to do today is very specific and clear. I'm a numbers person. I believe in the numbers. I have a structure. I have a methodology. And even though it took me 10 years to learn this from the first trade I made in the summer of 1967, I learned it well. It took me 5 years to forget all the bad information that I was learning, and it took me 10 years to learn the good information. We know that in the markets, there are at least 1 million things you can do wrong. There's only a few things you can do right. So if you're a trader or an investor and you feel that you're learning from your mistakes, it's not going to happen for you. If you learn from your mistakes and you say, I won't make that same mistake again, you'll make another mistake that's a brother or a cousin of the mistake you made. You need to learn from your profits. What did you do right? What did you do to make money? How did you do it? Repeat the process. Rinse, wash, repeat. Rinse, wash, repeat. So that's what we're going to do today. I have an ambitious agenda here today, as you can see. There's a lot of things I want to talk about. I don't know if I'll have the time, but that's okay. You can always write me. My email address is at the bottom, and I'm happy to answer your questions. And I'm sure Ron will have some questions for me when I'm done. So let's begin. Today, we're going to look at the major trends. Were my forecasts from last year correct? I'm going to give a brief comment on geopolitical deterioration. I spoke to ChatGPT, and Peter, I'll show you one of the things that AI is good for. We want to know how she did. We asked her about the fourth turning, and we'll talk about that. I'm going to look at some major setups and triggers that are developing right now, I'm going to try and answer the question, inflation, reflation, recession. I'm going to review my methodology, and I'm going to give you at least 4 markets that have explosive potential right now. And folks, I have nothing to sell you, nothing whatsoever. So let's go forward. The usual disclaimer, just in case you didn't know, you can lose money trading. Now, let's talk about this. Have you heard the expression, the bigger the front, the bigger the back? Well, let's see what it means. What exactly does it mean? Let's talk about the internet. The internet has a big front. In other words, it's a huge concept. People heralded the internet and said, it's incredible, it's going to change everything, and it has. But the dark side of the internet, we're just now beginning to appreciate. The hacking, the stealing, the social consequences of social media and so forth. The fake videos and recordings that go out over the internet assisted with AI. And even the developer of neural nets, Hinton, who was interviewed just recently on 60 Minutes, it's a chilling interview, watch it, admitted himself that he believes AI will take over and become independent and harmful. What did we discover from COVID? We discovered the bigger the front, in other words, COVID was very deadly. The bigger the backside of COVID, we learned that we can work at a distance. We learned that we can work remotely, among other things. We learned how to determine who is with you politically and who is not. It broke families apart and it brought families together. I'm not here to talk about all of that. I just want to mention it to you. So let's review. I'm going to talk about the forecasts that I gave in December of 2023. And with each market that I show, I will talk about my projections so that you will know what I'm expecting before I talk about it. And then I will show you some evidence to support my conclusions. First, let me say one more thing, and that is this. Everything we do, or I should say everything I do in trading and investing, and it's been 50 plus years, is based on patterns. Every pattern has a specific orientation to it. Example, reversal, key reversal, head and shoulders, pennant, flag, Fibonacci, Elliott wave. These are all patterns. The good news about patterns, there are thousands of them, and every day there are more of them. The bad news, most patterns have no predictive validity. So in case you're wondering why you're losing, why you may be losing, why you're not making as much as you should make, think about this. Is the pattern that you're using algorithmic? Is it specific and clear? Does it have predictive validity? Does it predict anything for the next day or the next week or the next month? We have computers. We can test the validity of those patterns. So before you use a pattern and say, I'm in love with key reversals, I'm in love with haramis, I'm in love with Elliott wave or whatever it is, make sure that it works. If you can't put it on the computer and test it, it's not going to help you. It's going to hurt you. So I will show you some of my patterns that have been proven effective and specific.
Jake, just on that point, wanted to check in with you on the slides. We see it in review, but not in full.
Okay, I'll make it full. Hold on a second.
Thank you very much.
One moment, please. Okay, my computer is not happy. Let's try it again. One moment. Oh, it's not happy at all. Just a moment. How's that?
Yeah, we just see in December 2023, full screen.
Okay. Do you see my pointer?
Yes, all good.
Okay, good. We'll continue.
Thank you, Jake.
Thank you. So let's review. My forecast in gold last year, bullish, expect new all-time highs, and a significant move after that, at least another $1,500 above where we are right now. That is my forecast. Silver, I projected $31 in silver. I now project $37 in silver, and I'll show you why. Copper, predicted new all-time highs in copper and recommended 4 different stocks to participate in the move. Copper is not over as yet. After all, someone has to make those bullets. I predicted new all-time highs in S&P. That has happened. It's not over yet. And again, let me say this. I may disagree with some of the other presenters here, but that does not necessarily mean that we will both be wrong or both be right. We could both be right about the market and the different things we say about it, because it's all about timing. So what I'm saying is this. The bull market in S&P is not over yet, and the bull market in NQ is not over yet. We still have higher to go. Based on the research that I do and the market sentiment that I've been publishing since 1985, the small trader is not on board this market yet. And it won't be until the small trader is actually exuberant that the market peaks. There's plenty of time yet. The small trader is still gnashing their teeth about missing this move in AI and NVIDIA. Therefore, it's not over yet, and I'll show you specific evidence of that. I predicted new all-time highs in cocoa. It happened. I predicted a top in the US dollar. It's happening right now. I predicted that AI stocks would take off. They are. I talked about geopolitical events which have come to pass. I indicated that interest rates would move higher and then bottom in 2024. And peak in 2024 with a low in interest rate futures. We predicted bear markets in grains and soybeans with lows due in late 2024. I predicted that palladium would make a significant low in 2024 because of massive record commercial buying of palladium futures. That has not happened yet. There is no timing yet because I work with a timing trigger as well as a cycle projection. So while the cycles are projecting a low and we have several elements in place, palladium has not made its move yet, and it will be explosive when it does. In fact, just the other day, yesterday or the day before, it moved up $50 an ounce very quickly. Excuse me. I predicted a bottom in platinum. That's happened. I predicted up moves in copper mining stocks. That's happened. I predicted a top in USA real estate residential. That's in the process of happening right now. I predicted a bottom in natural gas. That's happened. And I have told you not to buy lithium yet because the market was not ready for a bottom. I'll show you specifically what happened after that. So let's go forward. So my goal is today, and you can read this later on, to help you see what the forecasts are, and most of all, to help you make money, to keep you smart and informed with rational trades and investments based on facts. So let's go forward. And remember this, trading and investing are processes, not events. So we have to look at the process. The process that I use is called setup, trigger, and follow through. So every trade, whether it's a day trade, whether it's an intermediate term trade, whether it's a short-term trade, must have these 3 elements. Otherwise, there is no trade. There is no looks like, there is no could be, there is no overbought, there is no oversold. There is only a structure and a pattern. Let's talk about a pattern. If you haven't read this book or these books by Strauss and Howe, The Fourth Turning, you should do so. It's a fabulous book that talks about the big picture events and similarities between what's happening now and what's happened in the past. I went to ChatGPT and I asked her the question, what can you tell me about the fourth turning? And you'll be amazed with what she gave me. And I call her a she because mine is a female. Strauss and Howe postulated a 90-year pattern. And they showed that every part of the pattern has its various associated socio-political events and consequences. Based on the pattern, they estimated that we are about here at the high of the pattern. They did so based on the socioeconomic and political events that take place during these periods of time. Now remember, for me, this has nothing specifically to do with the market in terms of timing. It's just a big picture view. So when we gave the last session of the Foundation for the Study of Cycles forecast, we were in this area right here. Right now we are over here, coming close to a high. So what happens when you're close to a high? And this is the important thing right here. Check this out. This is truly amazing. She said, it's a very interesting question based on the theories of Strauss and Howe. The current period of American history is the fourth turning, which is a crisis. This means that we are facing a major challenge that requires collective action and sacrifice from all generations. According to the authors, the crisis is triggered by a catalyst such as pandemic, terrorist attack, financial collapse, creates a mood shift and a sense of urgency. So how many of these are already happening right now, in fact? Terrorist attacks, the pandemic, and another one likely on the way, or a financial collapse. The financial collapse hasn't happened yet. It's still too early for it, but keep this in mind. Let's go to the next point. She said that the crisis will last for about 10 years, specifically from 2020 to 2030. And this period of time is what's happening right now. And let's look at some of the events. Rise in nationalism and populism. Now think about that. That's happening all over the world. It's happening in Hungary. It's beginning to happen in the United States. It's happening in countries all over the world where leaders appeal to the emotions and fears of their followers and use divisive rhetoric and polarity and polarized society. Think about the polarization of society and where it's happening all over the world. What about this one? Decline in the trust among institutions such as democracy, media, education, and science, and people are questioning the Supreme Court of the United States. They're cynical about authority. Former President Trump regularly mocks the authorities. They claim to have solutions to the problems. What else is happening? Surge in violence and crime? Absolutely. Riots, protests, looting, vandalism, and civil unrest. You've got throngs of people going into stores in San Francisco and robbing right in front of your very eyes in packs and packs of vandals. And you have also shift in gender roles. Think about that. Women and children take on more responsibilities. Men become more isolated and depressed. Very, very true. Now, I'm not a social scientist. I won't attest any of these facts, but you want to take a look and see what's happening. And again, revival of religion and spirituality. These are all the correlates of economic and social peaks. That's fine. Let's be prepared for it. We can't get away from it. I believe that it's slowly but surely heading in that direction. So let's be careful. But read the book. What I want to do today is give you some ways to prepare for this. So let's look at this. I have a trading model. If a trade or an investment does not fit into my model, I won't trade it. It's that simple for me. The first element is the setup. As I said before, the setup is a pattern, a cycle, a seasonal, a Fibonacci, Elliott wave. These are all patterns. The good news is, as I said before, we have a lot of patterns to choose from. The bad news is most of them don't work. So I will show you some setups today and show you how those setups trigger. What do I mean by that? Example, we know as a fact that buying S&P futures on or about the 28th of June and holding it until the third week of July has usually been right about 80% of the time using the proper stop loss and profit target. That is a fact, demonstrable fact. You can search for that fact and find that it's verifiable, and you can even have AI search for it. So that setup, which we just talked about, the seasonality, needs a trigger. That trigger could be anything. It could be a traditional timing indicator. It could be a breakout. It could be a 50-day moving average above the 200-day, any of those. But none of those indicators will work without a setup in front of them. So first you've got a setup. That setup must trigger. The third part of the structure is follow through, the thing that most people are not good at. How do you take that $400 profit and turn it into a $4,000 profit? How do you manage the trade? Are you true to the risk? Do you get out when you're supposed to? So this is the whole structure, and I tell you how to do this in specific detail in just a little while. Let's take a look at another slide. So, if you want to come back and replay this video later on and go through this and look at the specific points that I made, I'm not going to bother reading to you. You didn't come here for that. What I want to do is show you some specifics. So let's take a look at some markets and I'll show you my work. So, here are my 3 factors. Factor number 1 is the setup. To find setups, I use cycles, the Commitment of Traders Report commercials, and small trader sentiment. Most people have never heard of COT, Commitment of Traders Report. Most people have never heard of small trader sentiment. Once these 3 factors are in place, I look for a trigger. And once I get a trigger, I look for follow through. I will show you specifically what I mean. Let's go to the next slide. As an example, here is a little cycle. And by the way, I did not use any fancy programs to get these cycles. I just placed them visually. They're not perfect. As we know, cycles are not completely symmetrical, but they do have value as part of the first 3 steps. Setup, which consists of cycles, Commitment of Traders Report, and small trader sentiment. So look at these cycles. In a perfectly symmetrical world, we would be in the midpoint of this cycle with the top developing in the Bitcoin versus US dollar. It's a beautiful cycle, not perfect. We know the length of this cycle. We also know this. Right now, I will be looking for a trigger to go short, but without a trigger, there's no trade. I can take that cycle and lower it to a weekly chart. Here's the weekly cycle. Again, not perfect, not symmetrical, but nonetheless, also peaking in midpoint right over here. So what am I looking for? Following my previously bullish forecast when Bitcoin was much lower, I'm looking for a top. People get very upset when I say that. They're married to Bitcoin. They love it. How could Bitcoin possibly go down? I received a lot of flack from people a couple of days ago when I made this projection, but I can give you a better thing to do, and that is this. If you've been waiting to buy Bitcoin, you're going to have your opportunity late this year, in September, October, November, possibly as late as December. So get ready. And if you own Bitcoin now, no problem. You've been in for a beautiful ride. Trail some stops and lock in some profit. Don't give it all back. But let's take a look at something else. And I will take questions at the end. So let's take a look at this. Here is the gold chart, my cycle chart on gold. Do note the cycle right over here, although not perfect, not symmetrical, gives me important information about what? Important information about my step 1, which is the setup. Do notice this. Cycle low, cycle low, cycle low here. On this chart, I have another indicator at the bottom. What is the mystery indicator? It is small trader sentiment. When the small retail customer is very bearish, in other words, 20% bullish or 80% bearish, and it correlates with a low in the cycle, as it did over here, we have the 2 important ingredients for a buy trigger. The next thing we do is go to our timing indicator to get us long, which we did right over here. Going back on the chart, let's look at this. What is this green stuff over here? This is the Commitment of Traders Commercials Index. What does it mean? It means that the Commodity Futures Trading Commission releases a report every week called the Commitment of Traders Report. The report shows the 3 main categories of traders: small traders, speculators, and commercials. Over 90% of the contracts in futures are being held by commercials. They're the biggest players in the game. Producers, end users, people who actually use the stuff that's being traded. Most of the time, commercials use the market for hedging. Therefore, they're short the market, but technically speaking, not short because they have the product. When the commercial trader is net long the market, as they are right over here, it means they need the product. They can't get their product from the supplier. Therefore, they buy hedge their commitments and get ready to take delivery if they can. And you'll notice that this period of extreme bullishness by commercials preceded this huge bull market. You'll notice that right now, there is no commercial buying. What does it mean? It means that commercial traders are not in a shortage situation. They've got plenty of product. They don't need to worry about it. If the commercial trader begins to show up as net long, that would be a different story entirely and would predict an explosive bull market. But before we get caught up in that, let's remember, when this cyclical low is made and my timing triggers triggered a buy, I stated specifically to expect gold prices to be higher until 2026, and I gave it specific symbols to buy in stocks. Let's go forward and see what else is going on here. Here's a closer look at the cycle. This was the cycle low right over here, and this was the small trader negative sentiment. So do notice, small trader very negative, the market goes up. Small trader very bullish right over here, the market goes down. So even these small moves on this quarterly chart were indications that the small trader was going to be wrong. We know that the small trader is wrong most of the time, so we use that information as a part of a timing trigger. Let's zero in on this chart a little bit more. This is how the cycle looked, and you'll notice again, expectation of a cyclical low and small trader very negative. We're going to get into more detail on this momentarily. I just don't want to run out of time. So here's what I've done. I've correlated with a vertical line every place where the small trader was very negative and correlated it to price. Example, small trader negative, bottom. Small trader negative, bottom. Small trader negative, bottom. Small trader negative, bottom. And vice versa. Small trader very bullish, right before this top right over here. Small trader very bullish over here. And again, the market goes down. So let's go to this chart. Here's the gold chart subsequent to the fact. In other words, this is the chart right now. Here's where the forecast of new all-time highs was given, and here's where we are right now. This move, as I said before, is just beginning. Even if we have a symmetrical cycle, which would peak right over here, we're still good until mid to late 2025 for a bull market. So I don't believe we've seen the top of that market yet. And by the way, do note this very high level in small trader sentiment came right at the top of this move right over here. But we'll deal with that later. Let's just go forward. What about copper? Here was the situation in copper, and this is exactly what I'm talking about. Just watch. Copper commercials right now are long 5,600 and let me check the date. Okay, this was in mid to late 23, right over here. At this time, commercials were long 5,500 contracts of copper. And that came right after the cyclical low right over here. The copper cycle has been one of the most predictable cycles of everything that I do. And you'll notice that over here in late 2023, at the time of the last forecast, commercials were buyers. Because commercials were buyers and small traders were getting negative on the market, that indicated to me it's time to buy copper. I gave specific recommendations in a number of symbols, and this is what happened to copper prices right over here. One moment, please. Let me show you. So this is copper current chart. This is where we recommended buying copper. This was a situation at that time. Commercials were buying copper very heavily, and the small trader was very negative. That's how the whole thing plays out. Right now, we're past the midpoint of the copper cycle. Has it given a sell? It's only given two Two indications. We are past the midpoint of the cycle. The small trader is very bullish. The last time the small trader was very bullish was right over here, and that preceded a further decline. So it's possible that copper may be topping, but we don't have all elements in place yet, by which I mean a trigger. So we'd have to go down to the lowest level and find a trigger. And the trigger is not in sight as yet. Notice again this. Huge commercial buying activity before the up move. Huge commercial buying activity before the up move. This is a combination that's very important that most people don't pay attention to. You need to put the cycle with timing and COT and small trader sentiment all together in one big stew, and then look at timing. Let's look at the next chart. Here is a timing indicator. One of my timing indicators that's called the intermediate term trader, where we look at big moves. This is what the copper market looked like back in December of 2023 before the move started. This is what it looks like today. So here's where it turned bullish, and here's what happened. And this is completely in line with the big cycle that we were talking about before. Let's go to the next one. Okay, I've been through this with you. Let's look at another market. British pound versus US dollar. The British pound has had one of the most perfect cycles I've ever seen back to the 1950s, making lows approximately every 8.1 years. So this is where the chart was in January of 2023. The cycle was projected to bottom right over here. So you can see that even though commercials were buying, which caused this push to the upside, the bottom, the major low is not in place yet, and it is still to come sometime this year. So what would we want to do in that case? Very easy. We want to sell the US dollar and buy the pound sterling, but we would need to fine-tune our timing in order to do that. Let's go to the next slide and see if I can show you some more close-ups. There we go. So here is a more pristine look at the British pound versus the US dollar, and here's that beautiful, almost symmetrical cycle that goes back many years. And what was happening? Commercials were small buyers, but the projection for the low is not due until late this year. The next few months will be critical in determining what we do. And you'll also notice there's some significant political intrigue going on in Great Britain, which is not unusual when cycles are making lows or highs. Let's look at another chart. One moment, please. So we can take the British pound cycle, and we can divide it into smaller segments like so. So what does this mean to me? This means to me that sometime in the very near future, we will get a bottom, which won't be the final low, but will be a bear market rally. And we want to time this with daily charts instead of weekly or monthly charts. Do notice also big commercial buying over here, small trader very negative over here, and we ensue a rally, a very good size rally. Remember, these are futures, which means the dollar value is very high for these moves. Let's take a look at another chart. And as I've said before, I'm happy to answer all questions. This is British pound again in December of 23, and this is the chart right now. So we're expecting a significant bottom within the next few months, and certainly into early 2025. This will be a prime opportunity to trade Forex from the long side British pound. Let's go to the next slide. How about cocoa? I realize that most people don't trade futures, but I want to show you something incredibly dramatic. This is the cocoa futures market, showing a very beautiful, almost symmetrical cycle, as well as commercial buying activity right over here and right over here. Note this very small blip right over here. Even though prices have been going higher, commercials were buyers. I want you to think about that. Why would commercials be buying as prices go up? Commercials usually want to buy as prices come down. They like to buy at wholesale and sell at retail. But this little blip over here at the beginning of a cycle was a giveaway. The projection was that cocoa prices would move higher. when that projection was made, cocoa had already been moving up. And then what happened? Right here. This was the commercial buying activity before this record-breaking move in cocoa prices. It has gone up incredibly. I've never seen a bull market this big, percentage-wise. For each futures contract, if someone was able to hold it, was a 419% gain, or $99,000 per contract. It will probably not repeat that process again, but look what happened. The small trader was very bullish before the top, and before the bottom, commercials started buying cocoa. So remember, this green activity here indicates commercial buying activity, not by all commercials, but by the majority of commercials. And they saw this move coming. Wait till you see what happens to the price of chocolate. Load up now, you're not going to believe it. Let's go to the next slide. How about a closer look? So this was the way the move looked when it started. And this was the timing trigger. And by the way, how can this help us in the stock market? Here's a stock of Hershey, the world's largest end user of cocoa. And look what happened. This here, with this here, constitutes a sell signal for me. So why would the price of cocoa, of Hershey's, go down if cocoa prices are going up? Very simple. It's arithmetic. They didn't hedge properly by buying sufficient amount of cocoa and had to go to the market and pay the cocoa price as it was activated in terms of the trend. Therefore, it cut into their bottom line profits. So they did not do anything smart in avoiding the market. They should have been buy hedged. But that's a Monday morning quarterback look for me. Let's take a look at the Qs. Here's the NASDAQ. I want you to see the specific situation that I'm talking about, because it couldn't be more perfect here. So first, let's admit that the cycle is not symmetrical. That's fine. They don't need to be symmetrical, as long as I know that a low in price is coming or due. What was the situation last year? The situation was, number one, I expected a cyclic low. Number two, commercials were buying futures. Number three, the small trader, the public, was the most bearish they had been for the entire chart. So, who are these commercials? Banks, financial institutions, hedge funds, sovereign wealth funds, and so forth, pension funds, IRAs, insurance companies. They were all net long. And what happened? Well, you know what happened. The forecast was for new all-time highs, and those new all-time highs were made. Here's a closer look at the chart. And this is where it was in December of 23. And again, do notice this. Even if you had no other tool than the Commitment of Traders report, check this out. They're long over here, market goes up. 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 Over here, they would have had to be pretty nimble to get out on time. But this is what it looked like when the bull move started. And again, small trader, very negative. So there's the combination. Large trader, long, cycle bottoming, small trader, negative. It's a winning combination. It's been beautiful and very productive for me. Let's take a closer look. This is the chart right now. So let's answer the question. What are commercials doing right now? You can see that they are net short 312 contracts. Why? Because they're hedged. Are they buying more? No. If they were buying more, it would show up over here, and it would be an extremely bullish development. So what to watch for? If you see over the next few weeks or months commercials turning bullish by being net buyers, that would be one of the most bullish things I've ever seen, and the market will explode before it reaches Peter's target of turning lower. Let's go to the next one. How about this? The Russell. Now this is the most interesting chart of all. As you know, if you're an investor, people have shunned the Russell lower tier of stocks. The Russell has been struggling. It has not gone crazy like the S&P or the NASDAQ. But look what was happening in 2023, late in the year, and starting in 2021. From 2021 to 2023, traders, commercials were net long the Russell at the cyclical low So again, if you feel there's validity to my forecast, even though the cycles are not perfect, you would expect the Russell to go higher. Let's look at what happens. December 23, and here we are now in in June of 24. So what happened? This is where the last chart left off, right over here. And this is where we were right now. What are commercials doing? They're net long. So, net long, 32,000 contracts. Their expectation is the Russell will go up and make new highs, new all-time highs. And here is the current, that's a crude oil chart. Just one moment. So what do we need now? Remember, setup, trigger, follow through. We have a setup. We have had a trigger on the weekly charts, and there's going to be a rotation, that's the forecast, from stocks that are highly speculative into stocks that are more stable, like the third tier of stocks. So watch the Russell for a buying opportunity, and watch the Russell for an up move to new all-time highs. Let's go to crude oil. Here's the crude oil. The cycle in late 2023 was still in an upward move, and it was forecast to move higher until 2025, late 2025, if the cycle was symmetrical. We know that the cycle is not symmetrical, so we break it down into several segments like this. Now let's take another look at the chart. Here is 2024, late in the session, late in the year. So we're expecting a low in crude oil prices. Everything over here in red is commercials, net, hedged to the market. In other words, there is no petroleum shortage anywhere in the world right now. Otherwise, commercials would be long. Therefore, we do not expect a massive bull market in crude oil. In fact, we expect a bottom later this year, in 2024. And again, these are very rough projections. I can give you more clarity at some point in the future, but I don't have much time here today, so I have to do this quickly. So here's the natural gas. As you know, natural gas is moving higher, and you'll notice this. Since 2007, commercials have been long natural gas almost all the time. Why? It's because of a specific characteristic of the natural gas market, namely, they can buy natural gas cheap and sell it at retail and continue to make money very easily. So this one would not be a good example to trade because the indicator is almost always bullish. Let's go to the next slide. We do know that waiting for a timing trigger is important. Therefore, this chart, which is a weekly chart showing a buy setup in natural gas UNG ETF, is kind of captured my attention and giving me an opportunity to buy when it triggers. What's the trigger? I have here Williams Accumulation Distribution, named after my good friend Larry Williams, and it's moving average. So when Williams, the blue line, crosses above the red line, it confirms this buy setup right over here. Let me go forward and show you a divergence chart. On a divergence chart, natural gas has triggered a buy as of 2 weeks ago. And let's go forward. Let's talk about interest rates. I want you to look at an amazing chart. This chart is euro-dollar interest rate futures, which are no longer traded. Basically the equivalent of the T-bill. This cycle over here, 1, 2, 3, 4, 5. 5 years has predicted almost every high and low in short-term interest rates. You'll notice again, prior to this big up move, the small trader is very negative. The commercial trader is bullish. Let's take a look at the continuation of this chart using T-notes. And this is a truly dramatic chart. Again, here's that cycle, approximately 1, 2, 3, 4, 5.5 years from low to low, almost symmetrical. And I want you to look at what commercial interests were doing in the net positions toward the end of 2023. They were net long 1,200,000 239,404 contracts. So why would they be net long the market? Easy. They're not doing it for their health. They're doing it for their wealth. In other words, they're buying in expectation of a big bull market in futures. If you understand the futures markets, you'll know that when futures are moving higher, when futures are moving higher, interest rates are moving lower. So think about it. From this point forward, the chart expectation based on a cycle was that futures would move higher, therefore indicating a top in interest rates themselves in the cash market. So what happened? Let's take a look at the chart right now. What do you see? A near perfect situation. Cycle bottoming, commercial trader long, almost 1 million contracts. What's going to happen? The forecast is really very simple. Expect futures to go up dramatically over the next year or two. Meaning what? Meaning lower interest rates. Let's project that a little forward. What would it mean if we had lower interest rates in the United States? It would mean the government wants to stimulate the economy. They would only want to stimulate the economy if they saw us going into a recession. That gives us a very big picture of what to expect. In other words, expect the economy to slow down, expect the Federal Reserve to pump money into the system, expect interest rates to go down, expect the bull market in futures. Let's see how that turns out. I couldn't be more specific than that. Let's go to the next one. And by the way, that also has implications for the US dollar. If interest rates in the United States go down relative to other countries, then the US dollar goes down as well, because the dollar is tied very intimately with interest rates. How about this one? US Treasury bonds, right over here. Let's look at the current chart. Actually, let's look at the bottoms first. Every one of these red arrows points to a cyclical low. Look at what happened after each one. Here, 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 and so forth. It's not perfect, but in terms of the structure I look at, setup, trigger, and follow through, it's a very beautiful picture that gives us a lot of information on what to do next. So that was the chart in September of 2023. And here is the chart right now. What do we have? We are making a low in interest rate futures. Commercials are net long. Let's see. I think they're net long. Either way, this is the important thing to look at right over here. Interest rate futures bottoming. Interest rates will likely go down a lot sooner than most people think. Let's see what else is going on here. Okay. So let's go to check this out. Oh, this is rather interesting. Many of you, especially in Canada, are familiar with the contract in what used to be called rapeseed, but is now called canola. I want you to see this very specifically. Look at this. Prior to this huge move up in futures, commercials seemingly out of nowhere begin an accumulation process along the market. They do it again right over here. And what happens? The move begins again. So this is the situation late last year. And this is the situation right now. The move is just beginning. And therefore, if you're Canadian and you're farming this product, you should be doing pretty well. And you don't want to be a hedger right now. One moment, please. I'm going to get a drink of water. The old man in me is starting to show. Continue. Okay, so let's look at this one. As an alternative to canola, we have soybean oil. Notice what happened. Soybean oil commercials goes very long the market prior to this huge up move. Let me show you a couple of more charts and then I'll take questions. Here we go. Soybean oil. I'm going to repeat. Well, let's look at another one. One moment, please. So, okay, let's look at this chart. Palladium. And this is a very, very big forecast. This chart goes back to July of last year, showing the palladium long-term cycle. And notice this, massive continued accumulation by commercials for a number of months, in fact, for over a year. The projection, higher palladium prices. I predict palladium prices will be explosive. However, we are still waiting for a trigger. We have this element in place here, cycle low. Number 2, commercial buying. Number 3, small trader, very negative. The process says wait for a trigger. And on some of the indicators, we have triggered PALL, the palladium ETF. But be very careful. This market will take your head off in futures if you're wrong. It can move $10,000 to $20,000 in one day per contract. Let's go on to a few more charts I want to show you before I run out of time. This is the this is the divergence trigger on the weekly palladium ETF, PALL. And this is a chart right now. I remind you, we were up $50 an ounce just the other day. Big surprise. And notice commercials continue to be buyers. One last point. Where is palladium produced? The 2 largest producers of palladium are Russia and South Africa. And they control the market. So you tell me what that means. Can palladium be used as a strategic weapon by withholding supply? Think about it. Let's do. And if you want to be buyer of palladium, you can buy it in bullion coins or in ingots. And this is a close-up of the chart in S&P. Check this out. In July of 2023, we saw this massive accumulation of long positions by commercials in S&P futures. That, combined with the cycle, gave me this process right over here. Cyclical low in S&P futures. Small trader was very negative before the bottom. The large commercial was buying, and bingo, you get the bull market showing right over here. And what's happened? Commercials have stopped their accumulation, which is not unusual. They buy it before the move happens, and when the move happens, they start to unload their contracts or they stop buying. It's a very simple, regularly normal occurrence in the market. And again, the second lowest low on the entire chart in small trader sentiment came just after the cyclical low and just at the bottom of the market. Very interesting indicators, and again, very specific and clear. I think I have 1 or 2 more charts to show you. Let's look at another one. Hold on, please. Sugar. What's likely in sugar? The sugar cycle is bottoming. It's not a symmetrical cycle. The small trader is getting very negative, but what's absent is commercial buying. Commercial buying was evident right over here, but lately, nothing new. Therefore, no setup as yet. Getting close. We watch it every day, every week, every month. And I think, one moment, please. You can go and find these charts on the internet. I want to show you one more. Yes, what's happening in corn as of the end of last year? For the first time in quite some time, commercials have started to buy corn. Corn has continued down, including today, but there's a setup. The corn market is bottoming, and here is that cycle right now. There's the combination, as I said before, cycle bottoming, commercial buying activity, small trader very negative. Expect a bull market in corn, wait for timing, and the same basic situation holds true in soybeans. So here's the corn chart, and here is, oh yes, one more before I forget. Japanese yen versus US dollar. A beautiful chart, beautiful cycle. 1, 2, 3, 4, 5, 6, 7, 8-year cycle, low to low. This is where we were toward the end of 2023. Let me show you the chart right now, because my forecast is watch for a big bull market in Japanese yen versus US dollar. Notice commercials have been buying for the better part of 3 years. Small trader has been negative for a long time. The cycle low is past due. All we need now is a timing trigger to get that huge move, and it's about time. So Ron, I am officially done with my presentation.
Awesome. presentation, Jake, as always, particularly the run through all key markets which are top of mind. If I may quickly recap, at the very top, you highlighted a bullish equity market view here and now, and perhaps for the rest of the year, but perhaps some risk ahead. In addition to that, we were looking at commodities, the full complex, some with some strong lead signals, others with potential setup still to play. And then I saw there on energy as an example, a bottom still ahead.
Yes.
And then just other highlights, I noticed that Eurodollar futures lower, suggesting lower rates, potential recession, and then the currency mentioned right at the end on US dollar, and most importantly, your big dollar yen call.
Correct.
If we start right at the beginning, Jake, this really interesting nuance in terms of different views on markets, particularly in terms of risk on and off, and just seeing that contrast there in terms of a mostly bearish view with our first speaker, contrasted with a short to medium term bullish view on yourself. How can you better clarify that in terms of your view, but then also how that may change over time?
Well, my view is constantly changing based on the facts, based on the data. So certainly what I'm presenting here could change if we don't get a trigger. So that's why it's very important for me to have all elements in place before I take action. It's very possible that 2 or 3 market analysts or traders such as myself can have very different points of view, because it's always a question of timing. And I would never be the one to say that cycles are perfect, which is why I need to have those 2 additional elements there. The cycle, the timing, the trigger, and the risk management must all fall into place correctly. And I would say also this, the Commitment of Traders report, a very valuable piece of information, available at literally no charge from the US government every week. It's just fascinating that people don't use it and don't even know it exists. In fact, a few years ago, there was a move by commercials to stop publishing the COT because it contains such valuable information. But that move was overridden by the public who wants to see it. So again, I would say to you, it's a question of elements falling into place, not just one or 2 or 3 of those. And it doesn't necessarily mean that I disagree with the first speaker. We could both be right, we could both be wrong.
Thank you very much, and nicely clarified just there. In terms of triggers that you're watching, either for the bull or the bear case here or later, what's top of mind here now on equity markets in terms of triggers on your screen?
Great question. The most powerful trigger that I know of is divergence. Example, price makes a new all-time high, momentum divergence does not. So if you compare momentum and price, they should move in parallel with each other. As price goes up, momentum goes up. As price makes a new high, momentum makes a new high. If that does not happen, it's a leading indicator for a top, and that's the thing to be careful of. Also very important is seasonality. Seasonality, as you know, as many traders know, is to the downside beginning in September, and October, November are 2 of the most significantly bearish months of the year. On the other hand, July happens to be a very bullish month, especially the next 2 weeks. So it would be no surprise to me if the market continues higher. It would be no surprise to me if the market sells off until Friday, when the 28th comes, which is usually a bottom in the market. Thereafter, we start to look at the seasonal weekly and determine what they're saying and if they're following in phase with momentum. So again, divergence is the most important indicator for me of the top as well as the bottom, as is small trader sentiment. The small trader, as you know, is usually wrong. And so if there's a way to monitor that behavior, we want to do that as often as we can.
Thank you, Jake. So a triple whammy trigger of the divergence, commitment of traders, and seasonality ahead in September.
That's correct. That's what it looks like right now, but I reserve the right to change my mind depending on the facts. And I will say one more thing. I'm a numbers-based trader. I don't think about politics except as entertainment. I don't think of worldwide events except as entertainment. Certainly I'm concerned about worldwide events, but they do not impact what I'm doing. The markets will usually tell us ahead of time what those events will be.
And our following question is on commodity markets that you had highlighted across the board. So we looked at, energy, just the last chart, but we also had precious metals, industrial, and agricultural stocks. Out of all of that complex, Jake, which commodities still have the best setups?
Oh, that is a beautiful question. Let me give that a few moments of thought here.
Take your time.
I would say, as boring as it may sound, the wheat and the corn and the soybean complex have the best potential in terms of size of gain, percentage of move. I also like secondarily interest rate futures from the long side as soon as we have a trigger, which is coming very soon. Those would be my favorites. And as yet, we have not seen a blow-off top in stocks. So all of this nonsense about NVIDIA, it doesn't mean anything to me. The money that's coming out of NVIDIA is going to go into other technology stocks. We live in a technological world that is ever increasing in its reach, and we haven't even seen the beginning of that technology as yet.
Interesting potential bifurcation there on tech and the stock complex. And certainly we're seeing a big move on NVIDIA, but it's done it before and it's shot back up again. So it'll be interesting to see how things play out. Looking on your point about setups and particularly your framework for looking at sentiment and commercials buying. One of our audience members, Pete, is asking, what type of look back period are you using to measure commercial buying? There seems to be multi-year periods without any commercial long positions, is an observation that he made.
Yeah, the commercials, the COT is released once a week. So I cannot look at it on daily charts. It doesn't help me. So I need to use weekly or monthly charts for the COT, if that's what the question was about. Many commodities will rarely show a commitment of traders report on the long side. Most of the time, the COT shows commitment of traders. Commercials are net short their market, which means they're hedged. I'm only interested in the COT when the commercials are on the long side because it means they need the product. So looking at this chart, for example, wheat, you can see that commercials have been basically buying wheat since the middle of 2022 until now, until the end of the chart. That's a very significant indication that they need the product. If they didn't need the product, if they needed the product, let me show you one more thing. Just one thing here. Just bear with me, Ron.
Live market review is great.
Oh, thank you. Thank you very much. Okay, so what I'm saying is this. The fact that commercials are buying wheat means they can't get a sufficient quantity from the producer. If you think about it in terms of fundamentals, where are those producers? Well, one of the biggest producers is Ukraine. So the commercial has to hedge their commitments to get product to make bread or whatever else they want to make, which is why they're net long the market. That means increased demand, which means it's an opportunity for me to buy on a trigger. I don't know if I answered the question thoroughly, but certainly they're always welcome to write me.
Thank you, Jake. And that's a good point for further technical questions or let's say in this case, sentiment related with more detail. Feel free to follow up either with the FSC or direct to Jake Bernstein. We have a similar one up here on the screen from MECO, if I'm pronouncing it correctly, on how small trader sentiment is calculated. So just a basic education question there.
We calculate the small trader sentiment as a survey. So at the end of each day, we have an idea of what percentage of small traders are bullish and what percentage of small traders are bearish. And we do that out of my office, and we've been doing that since 1987 every day. So we have a massively long database of small trader sentiment. And it's very helpful in predicting highs and lows. So if, for example, on this chart, you see the small trader very negative, with the commercial very bullish, with the cycle bottoming. We have all three elements in place for a potential bull market. And that was at the end of November of last year. We needed a trigger. I don't know if we had one offhand without looking at the chart, but that's how the combination works.
Thank you, Jake. And just a grand finale question for myself on currency. So you showed dollar or yen as the ongoing big call in the bottom and the upside ahead. And I recall you presenting on that in the past and predicting correctly what happened. Question on the US dollar, because you mentioned that should also undergo some interesting setups, partly given because of a potential lowering rate environment and what that might mean for the US dollar.
Correct. If the interest rate cycle is correct and the Fed begins lowering rates, which I think they will do, which I think they will be forced to do, that would be a significant indication of weakness in the US dollar, which, of course, remember, the US dollar index futures is a combination of a number of different currencies. So it's not a pure indication, but that's likely what will happen as interest rates come down. Dollar should come down, and therefore yen and British pound, my two favorite currencies right now, should go up.
Thank you. And we just wanted to also let our audience members know that there's a FSC seasonality show that you'll be going live with, and any comments that you can share in terms of what people can look forward to and insights that can be shared.
Yes, what I'm going to do every week is highlight several seasonal trades with high probability, and showing the entry, the exit, the history, the historical performance, and giving a specific timing trigger so people will see how these work out. And some of the best seasonals are actually not in markets that you would think are seasonal, such as the grains or the meats. They're actually in the currencies and the interest rate futures.
Thank you so much, Jake. It's fantastic hearing your market views and having this Q&A extended session. Thank you so much.
My pleasure, and maybe by the next time I have my voice back.
Get well soon.
Thank you. And thank you for everyone at the foundation for your hard work. Really appreciate it, and thank you all for attending. If you want more information, you can go to my website, jakebernstein.com. Thank you.
Thank you very much. To our two speakers, Peter Eliades and Jake Bernstein, we still have more to follow on day 2 and 3 as part of this 3-day FSC mid-year outlook for the second half of 2024. Just to remind, on the follow-up slides, we have 2 additional speakers tomorrow, hearing from Lars von Thienen, the duration of the current Bitcoin bull cycle. How much longer will good times last? We've been following Lars's work for some time on crypto in particular, but of course, as part of these weekly Cycles TV. And then to follow Dr. Richard Smith, our FSC chairman, who has also launched a new Cycles TV program for short-term cycles. Tune in on our FSC YouTube channel for that. Dr. Richard Smith will be talking about short-term cycles, specifically in US equities. He may add other markets if you ask, but please look forward to joining us tomorrow for further key insights. And then just to close, keep in mind day 3, FSC board members Bill Cerubi, US Stocks 2024 into 2025, and then Andrew Pancholi, The Power of Roadmaps, There Are No Black Swans. Thank you, everyone. Best wishes to all. Ron William, FSC Development Director. We look forward to tuning in with all of you tomorrow. All the best. Thank you.